Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday, everybody. A piece of housekeeping at the beginning of the episode. I am traveling to Bangkok, Thailand next week to meet with a few clients. I would be interested in meeting up with any viewers who may be there. So if you're in Bangkok and you'd be interested in perhaps meeting up, my channel email is in the description below. Flick me off an email and we can try to organize something. Okay, let's move into the episode. It's been a heavy week with Xi's trip to Russia, the Ukraine war, and US-China relations. It's Saturday today, so let's try to keep it a bit lighter with today's video and move through just the key economic and financial developments. And let's start with the property sector. Chinese financial media outlet Caixin has produced a wonderful set of reports as well as useful graphs in both Chinese and English this week, which provide good illustrations of where China's property crisis is generally and the poor position of Evergrande, who is back in the news this week specifically. Let's now move through some of these reports, quoting Caixin analysts, other analysts, and providing our own supplementary commentary where necessary. Caixin observes that China's financial authorities are hailing a rebound in the housing market after data from February showed an uptick in sales and the bottoming out of months of declining prices. Japanese investment bank Nomura echoed this optimism in a March 5th note, telling clients, quote, "We expect the sales recovery to extend into March and April and expect it to be a major catalyst to support property developers' share prices in the next few weeks." End quote. We have seen these official data for January and February, but we also remember that land use sales remained down by 1/3 year-on-year during the same period. So at the very least, the outlook is mixed. Indeed, ratings agency S&P Global said in a January report, quote, "We do not expect property sales to grow in 2023, with new construction starts and land spending dropping by about 1/3 in 2022. End quote. The Caixin analysts do admit, though, that since the positive data is from various groups of first and mid-tier cities, it's probably too early to assume there is strengthening throughout the national property market, with some expecting sales growth to return only by the second half of this year or even 2024. They add that there, quote, "is a striking geographic mismatch of demand and supply in China's housing market. The nationwide inventory of new property is at an 8-year high. While demand may be growing in higher-tier cities, the majority of supply is in third-tier and lower-tier cities where sales are falling behind in consumption." End quote. Indeed, National Bureau of Statistics sales figures indicate a recovery in first and second tier cities, where prices are up 0.2% and 0.1% respectively month on month in January, but in third and lower tier cities, prices continued to decline. An analyst at Beike Research Institute this week argues that rising demand in first-tier and core second-tier cities is being driven by favorable state policies as well as, quote, "robust local economies, industry, and large populations." End quote. Do we see this regional disparity in land use sales too? Yes, and the disparity is, frankly, quite shocking. According to data published this week from Zhuge Data Research Center, in February, the amount of land transactions by area in first and second tier cities rose by more than 30% month on month, but in third and fourth tier cities, it declined by 20 to 30%. This is an incredible disparity, perhaps the most shocking data I have seen this year to date, and it has many critical implications, not just in terms of less economic activity generally in poorer regions and lower tier cities, but because land sales are a critical source of funds for local governments, the disparity in government-provided services will grow substantially without politically difficult, large-scale redistribution from the central government. Meanwhile, going from the forest to one of the trees, China Evergrande Group has finally released details of a long-awaited restructuring plan this week. According to a Hong Kong Stock Exchange filing, offshore creditors will have the option to swap their debt into new notes with maturities of 10 to 12 years, or convert them into a combination of bonds and instruments tied to the shares of Evergrande. The same Hong Kong Stock Exchange filing also detailed, in all its infamous glory, its long-delayed 2021 financial statement. The statement shows almost $300 billion of liabilities. One dollar bond creditor speaking to Caixin expressed to the outlet, quote, "Investors looking at the restructuring plan would look at whether Evergrande has valuable assets to pay off its debts and if the company can resume normal operations until it can achieve a positive cash flow. Also, they want to know what binding measures Evergrande would agree on to ensure timely repayment in the future. However, it's obvious that the company doesn't have the ability to operate normally." End quote. Evergrande, of course, is no exceptional player in the wider market. It's just the largest of the over-leveraged actors. Many Chinese developers are in desperate need of capital after a near 2-year liquidity crisis that caused numerous property firms to default, triggered largely by Evergrande's mid-2021 default. Since September last year, though, central and local authorities have rolled out policies to support the supply side, from easing mortgage costs to opening up bond issuances again for many developers. We followed all of these developments as they occurred at the time. It may just be enough to keep many of these developers on life support. The question is, though, how much of this is simply kicking the deeper systemic issues with the sector down the road? There is also the issue of demand. While supply looks to be stabilizing, household demand and confidence still has some ways to go. Quote, "Previously, the property market drove the economy. This year, the economy must first recover, market confidence must strengthen. Only then will the property market stabilize." End quote. Next up, changes to the trust industry and a very bad year for brokerages. Hey guys, I hope you're having a great weekend. If you're enjoying the video, don't forget to hit that like button. And as always, anyone who can go that extra mile and help me keep the channel sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Okay, we have 2 more important economic and financial developments to cover, and then we can go and enjoy our weekend. First, the China Banking and Insurance Regulatory Commission has finalized the new rules which are expected to overhaul China's $3 trillion trust industry. They were published this week and will take effect on the 1st of June. Under the new rules, trust businesses would be divided into 3 categories: asset management, asset servicing, and charitable trusts. Depending on the categorization, trust companies will need to shrink the size of their non-compliant financing businesses and dispose of risky assets. Companies will have 3 years to adjust their operations for the new regulations, but plans for these changes need to be submitted to the regulator within 30 days. The trust industry has been a focus of China's wider financial risk clampdown over the past few years, following a series of high-profile crises at several important trust firms. And finally, US-based Bloomberg reports yesterday that recent profit warnings by Hong Kong units of Chinese brokerages, quote, "signal it will be a trying year for the firms weighed down by rising interest rates and lingering losses on real estate bets." End quote. Major players like Haitong International Securities Limited, which expects to post an $841 million loss in 2022, and Evergrande Bright Limited, last week posting a net loss, its first in almost 2 decades, are feeling the pain. Bloomberg explains that the results come after Hong Kong stocks last year suffered its biggest decline since 2011. Quote, "The brokerages would need to set aside provisions for the impairment losses after a wave of defaults and payment extensions last year. The bleak equity financing market also led to a slump in their underwriting income." End quote. Analysts expect stock volatility to intensify more this year due to tightenings from the US Federal Reserve, which will not be good for brokerages, which are of course highly susceptible to fluctuations in capital markets. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful day wherever you are. Have a great weekend, and I will see you all on Monday.